Something just happened in the metals market that most people are reading exactly backwards. Gold went on a tear, climbing to heights it had never touched in the history of money, and silver just sat there, barely moved. And the crowd looked at that gap, that stubborn silence out of silver while gold ran, and decided silver was the loser, the weak sister, the metal that let them down again. The big trading desks and the financial channels were perfectly happy to agree with that, because a discouraged silver holder who sells into the quiet is the easiest customer they will ever have. But I want to tell you why that gap, that stall, that maddening stillness out of silver while gold went vertical, is not the failure it looks like. It may be the single most important tell in this entire market. If you are holding silver right now, or if you are sitting on a retirement account and quietly wondering whether the metal everyone left for dead is finished, this is for you. I know the feeling. You watched gold grab all the headlines and all the glory, and somewhere in the back of your mind, you started to wonder if you had backed the wrong horse. So before you do anything you might regret, give me the next 20 minutes. Here is the fact almost nobody stops to sit with, and it is the fact the whole video is built on. Silver does not move with gold step for step, in a nice orderly line. That is not how it works, and it never has been. Silver lags, it stalls, it coils sideways for months, sometimes for years, while gold does the leading, and the crowd loses patience and walks away. And then, when momentum finally takes hold, silver does not catch up gently. It travels far and it travels fast, because it is a small and thin market where a little real conviction moves the price a very long way. Gold leads, silver follows late, and it follows violently. That is the pattern. And we have seen it before, at the end of the last great metals bull, in a way that anyone who lived through it never forgot. Go back with me to the final stretch of the 1970s. The whole decade had been a slow motion vindication for anyone who distrusted paper money. Gold had been legally chained at a fixed price for a generation, and when that chain finally came off in the early 1970s, when the dollar's last tie to gold was cut, the metal was free to tell the truth about what the currency was really worth, and the truth was ugly. Through that decade, gold climbed from the mid-30s, where the government had pinned it, up and up toward levels that would have sounded insane to anyone standing at the start of it. Gold got the headlines. Gold got the respect. Gold led. And silver, for long stretches of that same run, was the disappointment. This is the part people forget. Silver would build a base, grind sideways, and frustrate everybody who owned it, while gold made the news week after week. Picture the kind of man who owned it. A steady, unglamorous saver, the sort of person you might recognize in yourself, who had quietly set aside silver coins for years because he did not trust where paper money was headed. He spent long months watching gold get all the love, while his silver did nothing. He must have felt like a fool more than once. He held, anyway. And then, in the final act, everything he had waited through happened all at once. In that last stretch, once the momentum truly caught, silver did not just rise, it went vertical. In a matter of months, the price ran from the mid-teens toward the neighborhood of $50 an ounce, a level that, at the time, was simply unthinkable. The gains that gold had spread across most of a decade, silver delivered in a small fraction of that time. That patient saver who had sat on his coins through years of nothing suddenly held something worth many times what he had paid for it. The stall was never the story. The stall was the setup. The move, when it came, was so fast and so far that it permanently rewrote what people believed silver could do. And the reason silver behaves this way is not magic, it is structure. And once you understand the structure, you will never look at a silver stall the same way again. The silver market is small, genuinely small next to gold, small next to almost anything the big money touches. Most of the silver ever pulled out of the ground is already gone, used up, dispersed into electronics and solar panels and 1,000 industrial uses, burned off in tiny amounts that will never be economically worth recovering. Gold gets hoarded, silver gets consumed. So when demand finally turns and real buyers show up in size, there is no deep, calm ocean of metal waiting to absorb them. There is a puddle. And a little bit of genuine conviction hitting a thin, drained market does not nudge the price. It launches it. Now look at what is sitting in front of you today, and tell me it does not rhyme. Gold has run to record territory, leading the way exactly as it led in the 70s. And silver has lagged behind it again. The gap between them, what people call the gold-silver ratio, the number of ounces of silver it takes to buy a single ounce of gold, has stretched out wide toward the high end of its long historical range. And when that ratio is wide, it is telling you something plain and unmistakable. Silver is cheap relative to gold, historically cheap. That discount is not a verdict that silver is worthless. It is a measure of how far behind silver has fallen, and therefore of how far it may have to travel to catch back up. And here is a modern proof that the catch-up is real, not just a story from another era. Only a few years ago, in the panic that seized the world, silver crashed down toward the low teens while everything sold off at once, and the gold-silver ratio spiked to an extreme almost never seen, up toward 125 ounces of silver to 1 ounce of gold. The crowd said silver was dead. And then, over the following months, silver more than doubled off that low, and that wildly stretched ratio compressed hard and fast. The people who panicked at the bottom, who read the stall as the end, sold the exact spring that was about to release. That is not ancient history. That is recent memory. The pattern keeps repeating because the structure underneath it never changed. And every time silver falls while gold holds, that discount only gets deeper. The metal gets cheaper relative to gold than it already was. So the very move that makes you feel like a fool for holding, silver sliding while gold shines, is the move that is quietly loading the spring. The financial channels will frame it as silver failing. What it actually is, if history is any guide at all, is silver coiling. But a coiled spring is boring to watch, and boring does not sell advertising. And a frightened holder dumping metal into the quiet is a paying customer. So they let you believe the stall is the whole story, and they never once mention who profits when you believe it. And this is the right moment to stop and say something practical. Because if you are feeling that pull to protect what you have built, you are not alone, and you are not wrong to feel it. Here is something most people never get told. The biggest, most sophisticated buyers on the entire planet, the central banks, the institutions that actually move the world's money, have been buying gold at a pace we haven't seen in generations, adding well over 1,000 tons a year, hand over fist, for years running. They do not do that on a whim. But here is what almost nobody explains to an ordinary retiree. There is a perfectly legal, perfectly ordinary way for you to do the very same thing inside the retirement account you already have. You can move a portion of a 401k or an IRA into physical gold and silver, real metal, not a paper promise, without triggering taxes and without a penalty, through what is called a self-directed precious metals IRA. And this is not some private club for insiders. If you have $100,000 or more in any retirement account, this is squarely for you. We put together a free guide that walks through exactly how it works. If you are watching this on your television, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. Then come right back, because the next part is where this gets interesting. Now here is the part that actually changes things, and almost nobody gets to it, because you could listen to everything I have said so far and reasonably ask a hard question. Fine, but why now? Silver has stalled before and then gone nowhere for years afterward. What makes this coil any different from a dead spring? That is the honest question, and it deserves an honest answer. So let me give you one. The short version first. The setup underneath silver today is not just chart deep. It is structural, and it is the deepest it has been in a very long time. Consider this. The world has now run a structural deficit in silver for several straight years, meaning more silver is consumed each year than the mines and the recyclers can supply. Year after year, that gap has been filled by pulling down above-ground stockpiles, the accumulated metals sitting in vaults from decades past. That is not a sustainable arrangement, and you already know it in your gut. You cannot draw down a finite pile forever. Every single year of deficit brings the day closer when the metal simply is not there at the price the screen is quoting. And unlike gold, which mostly gets locked away and can, in theory, return to the market, industrial silver is scattered into products and gone for good. Gold is hoarded. Silver is burned. The supply side is tightening quietly while the paper price naps. And here is a fact that ought to stop you cold. That blow-off high from the end of the 70s, up near $50 an ounce, silver has bumped its head against roughly that same $50 ceiling more than once across the decades since. and been turned away each time. Which means, on the surface, silver has gone essentially nowhere in nominal terms across a span longer than many people watching have been alive. But think hard about what a dollar bought back then versus what a dollar buys now. Adjusted for everything that has happened to the currency in between, that old high is not $50. It is far, far above $50 in today's money. Silver has never once come close to reclaiming its real, inflation-adjusted peak. The base it has built beneath that ceiling is not measured in years. It is measured in decades. Now, I am not going to stand here and tell you the path from here is a straight line up, because it is not, and anyone who promises you that is not being honest with you. There is a real headwind right now, and it has a name. The Federal. Under Kevin Warsh, policymakers have kept interest rates higher rather than rushing to cut them, and their latest decision left them holding, with the committee visibly split, a divided Fed, some members pushing to be even tighter than they already are. And higher for longer real interest rates are the one thing that genuinely works against precious metals in the short run, because a bond that pays you a real return after inflation is the metal's only true competitor. Metal pays no interest, so when the return on cash and bonds stays high, it puts a lid on things. That is real, and I am not going to pretend it away to sell you a story. But here is the thing that should have every one of those trading desks quietly nervous, and it is the tell that ties this whole story together. For decades, there was an iron rule that every model on Wall Street relied on. When real yields rose, gold fell. They moved like two ends of a seesaw. Well, look at what just happened. Gold climbed to record highs even as real yields stayed high. The seesaw broke. The old inverse relationship that everyone leaned on simply stopped working. Something is bidding for gold that does not care about the interest rate math, something that keeps buying regardless. The central banks, buying reserves that no other country can freeze in a vault they do not control. Buying because trust in paper promises has been eroding in ways that do not show up in a rate decision. And if gold is already ignoring the very rule that used to hold it down, then the headwind the desks are counting on to keep silver asleep is far weaker than they think. And this brings me to the part one most want you to hear, because it is the part nobody on the financial channels is going to say to you plainly. The smart money already sees this. The central banks are not waiting for permission. They are already buying, already positioned, already treating gold as the reserve it has always been. Gold recently passed every currency but the dollar to become the second largest reserve asset held by central banks on Earth. That is not a forecast. That has already happened, quietly, while the headlines were busy elsewhere. But the crowd, the mainstream, the pension committees, and the neighbors at the dinner table, they have not caught on. Silver is still the metal everyone left for dead. And that gap, between what the smart money is quietly doing and what the crowd still believes, is exactly where you are standing right now. Understand what that means, because it is the whole reason any of this matters to you today. By the time silver's move becomes obvious, by the time it leads the news, by the time your brother-in-law is asking you about it at a cookout, by the time every advisor in the country is suddenly recommending it, the easy part will already be behind us. The catch-up will have happened. The wide discount will have closed. Nobody is going to call you the morning it begins and tell you to get positioned. Nobody sends you an invitation to the early part of a move. The early part, by its very nature, is the part that feels uncomfortable, the part where silver stalls while gold runs and the crowd calls you a fool for holding on. That discomfort is not the signal to leave. Historically, it has been the signal that you are early. So, what do you actually do with that? Nothing dramatic, just a few plain principles. Own the real thing. Physical metal you hold or that is held for you, not a paper claim that can be diluted 100 different ways when everyone tries to redeem it at the same moment. Size your position so that a shakeout, and there will be shakeouts, can never force you to sell at the bottom. That is the whole game right there. Never be the frightened holder dumping into the quiet, because that holder is precisely the one the desks are counting on. And hear me clearly, because I owe you this. This is a case, not a guarantee, and it is not personal financial advice. The volatility is real. Silver can and will drop hard along the way. It has fallen 30% in a matter of days before, on nothing more than an exchange raising the cost of holding it, while nothing about the actual metal changed at all. Prepare for that. Do not let it shake you out of a position you took for reasons that have not changed. So let me bring this all the way back to where we started. Gold ran, silver stalled, and the crowd read that as silver losing. But now you know the older, truer reading of it, that gold leads and silver follows late and violently, that the stall is the coil, that a thin and drained market travels far and fast once momentum finally takes hold, and that the discount only got deeper while everyone looked the other way. That is the signal hiding inside the disappointment. If you have watched me all the way to here, then you are clearly not the person who panic sells into the quiet, and I would like to do something for you. For viewers with $100,000 or more in a retirement account who watch to the end, we hold a free, one-on-one, no-obligation educational web conference. A real conversation about whether moving a portion of your savings into physical metal makes sense for your particular situation. And the honest reason to take that step now is not fear. It is the opposite of fear. The time to think a decision like this through calmly, while it is still cheap and reversible and nothing feels urgent, is exactly when nothing feels urgent, which is right now, before the crowd arrives. If you were watching on your television, scan the QR code on your screen. If you were on your phone or your computer, go to jeffreyguy.com. Silver has been the metal everyone left for dead more than once in living memory. And more than once, the people who mistook the coil for the end of the story were the same people who watched from the sidelines as it sprang. Gold ran. Silver stalled. Do not let anyone tell you that is the end of the sentence. Read it the way the last great blow-off taught us to read it, as the signal and not the failure, and position yourself before the part that finally gets loud. Because by the time it does, the quiet part, the part that actually mattered, will already be over.